Hi, everyone. Thanks for joining us for this quarter's presentation. I'm Ryan Lehman, iCM's Director of Investments, and I'm going to be your host today. Over the next 20 minutes or so, I'll be walking through the state of the closed-end fund market, as well as provide an update on the performance and the positioning of our tactical income strategies that do extensively utilize closed-end funds as part of their tactical asset allocation. If you do have any additional questions or would like more information on our tactical income strategies, do feel free to reach out to a member of our advisor services team. We're going to have all of that contact information available at the end of the presentation. So with that said, let's go ahead and jump right into things. So starting with the closed-end fund market, to just start at a universe level, discounts moved in marginally throughout the year. They ended 2025 at around 5% below NAV. However, we did see some kind of interesting dynamics if we look across asset classes. Now, most notably, discounts for taxable bonds, they did gap out a little bit, just about 200 basis points. This mainly occurred in Q4, and there doesn't really seem to be a fundamental reason for this because we did have credit spreads end the year pretty close to historic tights. So what we can likely chalk this up to is basically investor fatigue and possibly some profit taking with some really strong returns as we entered Q4 and discounts entering the quarter pretty well inside of their historic norms. Now, we did see the exact opposite within munis, where discounts narrowed by more than 300 basis points. Here, we saw an uptick in investor demand for munis as those technical and fundamental concerns that had been a decent headwind for the asset class, they faded throughout the year. And then we also saw a reduction in the risk that rates would rise and pressure prices for bonds here in the US. Then lastly, we've got international equity where discounts moved in from 11.5% below NAV to less than 7%. This largely came as investor appetite increased for international assets with such a strong resurgence in performance last year. Now, on this slide, what we're looking at is just how the discount environment changed on a quarter-over-quarter basis. And we do see a bit of a shift to the left in the distribution chart. So that indicates the discounts did widen a bit on the quarter. Then if we look out to the right, you're going to see that we now have just over 84% of the universe trading at a discount, which is slightly above the long-term average, but it is still about 10% below that really attractive opportunity or that really attractive universe statistic that we saw back in 2023 when there were a lot of opportunities available. So switching gears for the next couple slides, we're going to take a look at some of the key drivers of closed-end fund discounts. Here, we're starting with interest rates. So interest rates and closed-end fund discounts tend to exhibit a negative correlation, meaning that when rates decline, closed-end fund discounts tend to narrow, and then when rates rise, they tend to widen. And this is going to typically occur with just one caveat. When we have rates decline due to an event of extreme market stress or volatility, so think COVID pandemic, financial crisis, you do tend to see this relationship actually turn positive. So just to expand a bit in terms of what we're looking at on the slide, we're looking at the yield on the 10-year US Treasury in blue, and then the average muni bond fund discount in orange. We're using munis here because they do tend to carry more duration. They're going to be more interest rate sensitive than the taxable side of the closed-end fund market, which is more credit oriented. We're going to look at that next. But looking at this slide in particular, throughout the year, we saw muni discounts come in pretty meaningfully. This was somewhat supported by declining rates because we have seen rates come down from their peak. But I think it was more so attributable to muni discounts entering the year at pretty attractive levels. And then you pair that with declining concerns around the future path of rates going up in the future. And this is a narrative that we believe could continue to support muni funds as we look ahead, especially if the curve does continue to normalize and the Fed is able to continue lowering rates into 2026. So next, let's take a look at the relationship between discounts on taxable bond, closed-end funds, and credit spreads. So spreads were a bit volatile during the year, especially surrounding the Liberation Day tariff announcements. However, they did decline meaningfully from their peak, and they ended the year just above historic tights. So the question is, why the pullback in taxable bond discounts? Well, I kind of alluded to this already. I think a lot of it really has to do with the valuation environment, especially as we entered Q4. At pretty close to NAV, taxable bond closed-end funds weren't really offering great upside for tactical investors, especially with spreads currently so close to their floor. And it appears that what may have occurred was that investors were just simply locking in some of those strong gains that they had earned over much of the year and for the last couple of years, and really just searching for opportunities elsewhere. And in particular, we see those opportunities on the muni side of the market where valuations appeared much more attractive for most of 2025. And then lastly, here we see the relationship between equity market returns and broad closed-end fund discounts. Now, in terms of this relationship, behavioral finance, or that tendency for investors to over and underreact, that's going to play a really primary role in driving closed-end fund discounts. Because as many of us know, the closed-end fund market does tend to be pretty retail driven. And that's exactly what we see on this chart. Declines in equity markets and high volatility environments, they do tend to cause closed-end fund discounts to widen, while periods of strong returns or low volatility are going to tend to cause discounts to narrow for the most part. Now, we do see the universe-wide discounts narrow a bit in 2025, but this was really skewed by discount widening for taxable funds, which do account for a large part of the universe. Elsewhere, we saw pretty significant narrowing within munis and international equities in particular, and then some pretty meaningful narrowing in U.S. equities if we viewed them from the Liberation Day tariff announcement forward. And all this is going to correlate to that traditional relationship between equity gains, volatility, and universe-wide discounts as a whole. And I think that's a pretty good transition there to start talking about our flagship TICE strategy. So first, looking at portfolio attributes, our closed-end fund exposure did decline pretty meaningfully throughout the year. This should be pretty much in line with expectations given what we saw from a discount environment. We also had a number of fair value swaps throughout the year and funds that either merged or liquidated, with the latter translating into pretty significant closed-end fund alpha in most cases. Now, from a discount standpoint, at year end, we saw our average closed-end fund holding trading at a discount of 9%. This is a bit wider than where we ended the prior quarter and about 100 basis points more narrow than what we saw at the start of the year. And this was additive to performance in 2025, something we're going to see in a couple of slides. And then as of quarter end, TICE was offering investors a distribution yield of 4.62%. This has come down a little bit. There's a couple of reasons for that. So first, interest rates and spreads broadly declined a bit throughout the year. And then in addition, like I mentioned already, we did reduce our overall closed-end fund exposure, which is going to naturally lower your yield for the portfolio. But on a positive note, a happy byproduct of all this is it has reduced the weighted average expense ratio of the strategy, which was just around 57 basis points at year end. Now, to speak to where we're finding the greatest opportunities, here we're looking at the closed-end fund versus ETF breakdown for each sleeve of the portfolio, along with the average discount of that sleeve. And what you'll notice is that we're clearly finding the least opportunity in U.S. equities and taxable fixed income. There we've got a 78% and 71% allocation to ETFs respectively. For U.S. equities, this has been relatively high for much of the last year plus. Outside of the tariff-related volatility in April, the opportunities have not really been there in U.S. equities. However, I think a key observation to make in regard to our U.S. equity allocation is that despite the universe not looking great as a whole, the funds that we are invested in are trading at very attractive discounts, which averaged a little bit more than 11% below NAV at year end. And then similar to U.S. equities within taxable bonds, the funds that we do own are still trading at attractive valuations. We've got an average discount there at more than 9%. So the environment, not necessarily ripe with opportunities here, but we are still finding some pockets of value. Then on the flip side of this, we are still finding a good deal of opportunity in our municipal bond sleeve, although this was fully allocated to closed-end funds earlier in the year. Here we're allocated 70% to closed-end funds, with the average fund trading at a discount of more than 7% below NAV. And then lastly, in terms of non-US equity funds, that allocation has come down to an even 50-50 split due to that strong performance and discount action we saw in 2025. But again, still finding selective opportunities here. Our average holding trading at a 9% discount at the end of the year. So taking a little bit of a deeper dive into performance for our TICE strategy, what we're doing on this slide is we're essentially decomposing the strategy's returns into the three core building blocks of return: capital appreciation, dividend income, and then closed-end fund alpha. So in 2025, we saw positive returns or contributions from all of the key components for the strategy. We saw a 600 basis point contribution from capital appreciation, with both equities and bonds performing well in the year. We saw a positive 500 basis points coming from that yield component. And then our active discount management or closed-end fund alpha contributed 172 basis points. And I think this slide gives some really good insight into the benefit of using a strategy like TICE, where you do have the potential to benefit from multiple sources of return. And in particular, that unique closed-end fund alpha component, which isn't necessarily going to be accessible to traditional mutual fund and ETF investors. And I think this case was pretty clear in 2025, with that closed-end fund alpha component being responsible for pretty much all of our excess returns versus our blended index. And then, as expected, with that elevated yield we saw last year, the closed-end fund component, this has translated into pretty strong relative returns, not just last year, but over most trailing periods. So near term, our gross composite led its benchmark by just over 130 basis points. That was in 2025. And then over the long term, you're going to see outperformance of about 200 basis points annually over the last 5 years, and then 170 basis points annually since the inception of the strategy or the composite back in October 2016. And then from a risk standpoint, since inception, TICE has exhibited a standard deviation that is a bit higher than its blended benchmark. This is mainly going to be driven by the higher volatility nature of closed-end funds. However, despite that higher volatility, investors have been amply compensated in the form of that excess performance that we just talked about. Now, just to switch gears here for the remainder of the presentation, let's go ahead and discuss our TICE Alpha Opportunities strategy for TAO. So for those who aren't familiar, TAO is a unique set of strategies that combines our TICE closed-end fund alpha strategy with a portfolio of undervalued assets, which we're going to refer to as high conviction tactical assets. So everything that we've talked about thus far, that's going to apply to the first half of the portfolio, which is just an asset-weighted version of our TICE portfolio. In the next few slides, though, what I want to do is touch on where we're finding value from an asset class standpoint for the second portion of the TAO strategies and how all this is kind of translated and come together in terms of performance. So starting with our long-term return expectations, returns across the board came down during the year, largely due to that strong performance we saw out of both equity and fixed income markets. That said, though, we haven't seen any real meaningful shifts in the general order of things. So starting with equities, U.S. large caps, and in particular, large growth stocks, they're going to be to the far left with returns in the low to single digits or essentially flat for U.S. large growth. And then if we look at the far right of the slide, you're going to see non-U.S. equities and commodities still offering the greatest return potential over the next cycle. And then on the fixed income side on the bottom, most credit sensitive sectors, they've moved out to the far left with returns. They're pretty limited from here due to that very tight spread environment that we talked about. This applies to both high yield and investment grade corporates. Spreads there about as tight as they ever have been historically, despite the yields from those securities actually looking relatively attractive on an absolute basis. And then on the opposite side of the spectrum, you're going to see EMD, which had an absolute banner year in 2025 with a return of around 9%. And then also we've got longer dated treasuries, which have become increasingly attractive as the yield curve has steepened over the last year and a half or so. Now, the way this translates into the portfolio's asset allocation, that's shown on the two pie charts here. So on the equity side of the portfolio, you're going to find our highest allocations of 55 and 35% to emerging markets value and international value stocks, respectively. And then commodities, they've got a weight of 10%. Unchanged from the last quarter. However, throughout the year, we did take down our commodities weight a bit in favor of non-U.S. stocks, which has worked out pretty well for us. And then on the fixed income side of the portfolio, we continue to maintain this somewhat of a barbell position. So you're going to see EM local bonds, that's your risk asset on one side of the portfolio. And we balance that out with an allocation to short-term and long-term U.S. Treasuries. Now, the long-term Treasury position, just thinking back throughout the entire calendar year, that was implemented during Q2, and then we actually moved that up a little bit in Q3, and this did benefit the portfolio as the yield on the 30-year, that topped out around 5% during the middle of the summer, and then it actually ended the year a little bit over 4.8%. So getting into the rationale for some of those high conviction assets. So let's start with non-U.S. value stocks. Now, the majority of the story here, It's valuations and then fundamental improvement. Now, the valuation story hasn't really changed much. Non-US stocks, they look particularly cheap regardless of what metric you use, and this is on both a relative and an absolute basis. This has been the case for the last few years, but that fundamental catalyst that's just been lacking a little bit. However, it does look like that might be changing. So if we look to the right-hand side of this slide, you're going to see GDP estimates for the U.S., Europe, and emerging economies over the next number of years. And that U.S. exceptionalism story, that was clearly on full display in 2024, with the U.S. growing at a rate of 2.8% versus just 1% for the EU. However, as you start to look out over the next couple of years, that gap is expected to close and pretty meaningfully. It's expected to close all the way down to just 40 basis points by 2027. Just a couple of reasons for that. So Europe is in a much better position to stimulate their economy, while in reality, if we think about what it looks like at home, we likely need some form of austerity to kind of get our fiscal situation under control. And then in addition, the technology sector, which has really fueled U.S. growth over the last few years and accounts for a much larger part of our economy, that is expected to cool down a bit with earnings growth expectations for the Mag 7 names in particular coming down substantially over the next couple of years. So put this all together, and from both a valuation and fundamental standpoint, it does appear that things are starting to support potentially a continuation of this non-U.S. leadership trend that we did see on full display last year. Moving on to fixed income, emerging markets, local bonds, they experienced some pretty outsized performance this past year after a really difficult Q4 of 2024. And despite rising by more than 19% on a calendar year basis, we do still feel that there is still room to run here. There's really two reasons for that. So first, while spreads might not look overly attractive versus U.S. bonds, they do have a yield still on the index of around 6%. So you are still earning a pretty healthy premium over the U.S. Ag Bond Index and U.S. Treasuries. And then in addition, a key contributor to performance this past year has been weakness in the U.S. dollar. But despite that weakness, we do still view the dollar as pretty meaningfully overvalued versus the basket of EM currencies, with the possibility of that overvaluation and potential weakness in the dollar contributing about 2% to returns over the next cycle. So stack these two components on top of one another, and you're looking at potential annualized returns in, say, the 7 to 8% range compared to expectations of about 4 to 5% for U.S. investment grade bonds. And then lastly, we've got treasuries. So this slide shows the curve steepness of the 10 to 2 segment of the curve versus the entirety of the curve, or the 30 to 2 segment. And in both cases, we can see that the curve has been on a somewhat prolonged steepening path, with the depth of the flatness or actual inversion coming in June of 2023. And since then, the curve has been steepening, and it continued to do so in 2025. In fact, the 10 to 2 segment, that steepened by 35 basis points last year, while the overall curve, the 30 to 2, that steepened by about 80 basis points, meaning 2-year rates fell more than the 10-year, which fell more than the 30-year. And the fact that most of the rate movement was at the short end of the curve, treasuries didn't really benefit fully from the duration impact of a parallel shift in 2025. Now, the other key takeaway here is that while the front end of the curve has yet to return to kind of average steepness, the overall curve, particularly the back end, has, and this could lead to some additional tactical opportunities with the long bond as we continue to progress here through 2026. And then just to finish up with a couple more slides, talk about attribution and performance. Here you're going to see the recent performance of our high conviction asset classes compared to their policy benchmarks. Now, on the equity side of the portfolio, the TICE strategies have done well versus the policy benchmarks this past year. This was largely driven by the divergence we've seen in global equity performance, which was fueled by those strong returns out of non-U.S. stocks, and then additionally meaningful weakness in the dollar. Commodities, slight detractor. Here we've seen precious metals do exceptionally well, as most of us have probably heard about. But energy-related commodities, they did struggle a little bit due to some continued supply and demand imbalances. Now, our fixed income assets, they also outperformed their benchmark. This was largely driven by EMD performance. That gained over 19% in 2025. We see long-term treasuries down a little bit on the quarter, but if we look at them on a year-to-date basis, they have advanced by just about 5.5% through the end of the year. And as I mentioned just a moment or so ago, with yields falling so sharply at the short end of the curve, the long bonds didn't necessarily benefit from the overall move down in rates because the shift was not clearly not parallel in 2025. However, this does set long-term treasuries up in a pretty good spot as we look ahead, especially out into 2026. And then on a calendar year basis, what this has resulted in has been pretty strong results across the board for our gross composites. Closed-end fund performance been a little bit mixed this year with discounts so tight coming into 2025. So it was really our high conviction equity and fixed income assets that pretty much propelled the strategies past their benchmarks. If we look since inception, it goes back to April 2020, starting with our income ops strategy, that's our 1090 strategy. That's gained over 6% annually compared to a 2% gain for the blended benchmark. Performance here, that's been supported by our closed-end fund alpha sleeve, which added meaningfully to returns for just about every period except 2022. And then additionally, our short treasury and EMD positions, they've added value more recently. Now, on the flip side of that, our most aggressive portfolio, Tau 80/20, you're going to see excess returns of 159 basis points annually over that same period. And unlike income ops, this was actually largely driven by our positions in commodities and non-US value assets. So they provided a significant level of downside protection in that sell-off in 22. And then if we think about what non-US equities have done thus far in 2025, they were really a key catalyst for that more near-term performance. And what I think all this really highlights is an important component of Tau, and it's that ability to benefit from these different sources of return. So you've got closed-end fund alpha as well as those undervalued assets. And what makes it interesting is they do tend to run in varying cycles, and this does really help to provide competitive results across a variety of market environments, which is exactly what we've seen in practice since the inception of the strategies going back to 2020. And that does it for my comments today. I hope you enjoyed the presentation. Feel free to like, share, and subscribe. Also, if you do have any questions or you would like to learn more about our tactical income strategies, please feel free to reach out to a member of our advisor services team. You can see all of our contact info here as well as our website address on the slide. Thanks for watching, and I hope you can join us again next quarter.